It's Thursday, February 12, 2026. And when you look at the sources today, you see these two massive, seemingly disconnected stories.
They really do feel like they're from different planets.
On one hand, you have a corporate sector spending money on AI infrastructure at a rate that is just, it's almost hard to comprehend.
A trillion-dollar war, basically.
Exactly. And on the other hand, a labor market that has, for all intents and purposes, just ground to a halt. It's a total freeze on human capital.
It's the perfect way to frame it. Usually, that kind of infrastructure spending would mean a hiring boom follows right behind it.
Of course.
But 2026 is, it's just breaking that link. We're seeing what some are calling a jobless expansion. GDP is up, but headcount is basically flat.
Okay, we have to start with the spending, the CapEx numbers.
Right.
Because they are staggering. Alphabet just dropped their 2026 guidance.
Right.
They're planning to spend between 175 and, $185 billion?
Billion this year alone.
That's the size of a country's GDP. It's wild.
It is. It's a huge signal. They're trying to shift to what they're calling a premium leader strategy. They want to build an insurmountable moat against OpenAI and everyone else.
So that $185 billion is all for data centers, for compute.
Almost entirely. They're betting the entire farm on winning the AI race.
But that bet is causing some serious collateral damage, right?
Oh, absolutely.
Their shares plunged, nearly 12%, even though revenue was actually growing.
It's the classic margin squeeze. It's a paradox.
How so?
Well, the demand for all this AI hardware is so intense, it's created a supply bottleneck, specifically for one component, high bandwidth memory, or HBM.
Okay.
Cisco has to buy those chips to build their gear. But because HBM prices are just skyrocketing, their profits are, they're just evaporating.
So the people putting the boxes together get squeezed.
Exactly.
But the companies making the raw parts, the memory chips, they must be.
They're having a monster year.
Yeah.
You look at Micron, Kioxia, SanDisk.
Yeah.
Their outlooks are through the roof. They control the scarce resource.
So it's a huge wealth transfer.
It's a complete transfer of the profit pool. It's shifting away from the integrators and flowing directly to whoever owns the HBM production lines.
And this massive rotation into hardware, into CapEx, that has to explain what we're seeing in the labor market.
It's the other side of the same coin.
This idea that companies are just swapping payroll for processors.
Swapping OpEx for CapEx. You saw it in the January jobs report. The headline number, 130,000 new jobs. It looked great.
Yeah, it crushed the forecast.
But the real story was buried in the fine print, in the revisions for all of 2025.
The revisions were brutal, weren't they?
They were. The new data shows that for the entire year of 2025, the U.S. economy added only about 181,000 jobs total.
That's an average of just 15,000 jobs a month. That's nothing. That's stall speed.
It's the weakest pace in 2 decades if you exclude actual recessions. It confirms this low-hire, low-fire environment we've been talking about.
So no mass layoffs, but the hiring tap has just turned completely off.
Correct. And if you dig into where those few jobs are coming from, the picture gets even clearer.
Right. It's not broad-based.
Not at all. It's all government and healthcare propping up the numbers. If you strip those out, the private sector, specifically white-collar jobs like tech and finance, it's actually shrinking.
A white-collar recession.
That's the term for it. The sectors that are spending all this money on AI are achieving growth through efficiency, not through hiring. They can expand output without adding a single new desk.
So that leaves us with this huge paradox for the year ahead. We have this jobless expansion, corporate profits look good, hardware spending is off the charts. But the mechanism that normally gets that growth out to the population, the paycheck, seems to be broken.
You're disconnecting the stock market from the real economy when growth is all capital intensive and not labor intensive.
Which really leads to the big question I want to leave you with.
Yeah.
If growth now comes from buying more GPUs instead of hiring more people, how long can the consumer economy hold up?
Right. Eventually, someone needs that paycheck to buy the services these AI systems are creating.
That feels like the structural ceiling we're going to hit.
Sooner rather than later, I think.
Definitely something to watch. Thanks for joining us on this deep dive. We'll see you next time.